Hi, I'm Pattu from freefincal. Today let's take a look at the two new NFOs from Mirae, the Mirae NYSE FANG Plus ETF and a fund of fund based on that ETF. The ETF will be tracking the NYSE FANG Plus Total Return Index. Now, if there is one index that is based on the most selective of cherry picking, based on serious hindsight bias, is this FANG Plus index. It's even worse than the Nasdaq 100 in terms of volatility and returns, obviously. So the problem is that we have a bunch of people who just look at the last 1 year returns and they immediately go saying they want diversification and so on. Those who want to invest in US equity or even truly international equity, they don't really understand and appreciate the implications and consequences of having that small exposure of 10% or 15%. Even that small exposure should be regularly rebalanced regardless of tax. Otherwise, the so-called diversification benefit will be absent. And most people don't even understand what diversification benefit is, I'm sorry to say. But, well, all that being that, let's take a look at this index, and obviously you know what I would say whenever there's an NFO. Most people would know by now what I would be saying, and still people ask me to review an NFO, and I've already told you who benefits when I review an NFO. Only me. So this has a amusing security selection policy. It says high growth technology, internets and social media industry with significant revenue exposures to one or more areas of search, social networking, autonomous driving, electric vehicles, smartphones, mobile payments, e-commerce, online games, blah blah blah. So it looks like somebody had a look at a few good stocks. Oh, Amazon is doing well, Tesla is doing well, Facebook is doing well, so let's create an index around it. And that's the kind of hindsight, but there is no difference between the construction of this index and all those WhatsApp stories you hear about. If you had bought Wipro when it was IPO, or if you had bought Tata, Infosys, or whatever, something like, now you would have made this many crores and so on. There's no difference between those kind of anecdotes and this index construction. I mean, it's just crazy. And to make it worse, they say they will have equal weighting, they will have minimum 10 stocks. So that just makes it automatically, it's going to make it higher volatility and sometimes higher reward. So this is the NYSE FANG Plus return, price return, the Nasdaq total return, the S&P 500 total return, all of them in USDs from inception in somewhere in September 2014 for the NYSE FANG Plus. And when you look at this, before that, so I couldn't get total returns data, but there's the difference between since inception price return and since inception total return is just 0.29%. So there's not much of a difference. So we can use price return for this simple analysis for whatever it's worth. So the index itself has inception from 2014, but it was started only from I don't remember, 2019 or so. Let me just check, I forgot. So 2017, it opened only on 2017, so it has backtested data up to only 2014. So it's a very very young index. And so when you see this, what do you see? Some people may see this up and so on, but I can only see that's like 2.5-3 years of flat returns in spite of having such great stocks. So it's a very high risk, possibly high reward kind of strategy, but most of the reward came in the last year or so, and then you can see it has already fell since then and then moved up a bit and so on. It's almost like having an ESOP. That's the kind of index it is. And you can see the drawdowns. This is the maximum fall from a peak. You can see that the red line is the FANG Plus index. You can see the red spikes are very huge, except for the March 2020 crash, where everything was together. And you can see that this red spike took a lot longer to move up. So the time underwater, the time it was below the maximum, is much larger for this index than the Nasdaq or the S&P 500. So you know what I'm going to say. It's just crazy to buy this. This is stupidity. and I can only plot 2-year returns because there's not much of history, and you can see even those 2-year returns how much more volatile the yellow line is, which is the FANG plus, compared to the brown line, which is Nasdaq and the Nasdaq 100, and pink line, which is S&P 500. So it makes no sense to buy it. It's a seriously cherry picked index. I would strongly recommend that you don't buy. Some people will not listen and still buy. For those people who are looking at those great lucrative returns and say they think they have high risk appetite. Everybody who says they have high risk appetite are basically those with they don't have any experience, and that's why they think they have high risk appetite. So those who are going to make the mistake of saying I have high risk appetite, I'm going to buy it. At the very least, please don't buy the ETF. Don't buy it immediately. Wait for the AUM to collect. Look at the price nav deviations of the ETF, and then buy the fund of fund. Don't buy the ETF, because when you buy the fund of fund, at the very least you are going to buy and sell directly with the AMC. Although the biggest drawback is that the fund of fund will buy from the ETF price. So unless the price nav deviation of the ETF itself is not too significant, then there's no point buying the fund of fund itself. So it's not, first of all, it's a seriously cherry picked index. Even if you go past that logic, you must look at the way in which it is being presented to you as a product, and that's just not inviting enough. So please avoid. And for those of you who are buying some kind of international equity, please take some time to do some portfolio management from time to time and understand what is the real place. If you have some 5%, 10% of equity of S&P 500 index, for example, or that the other index, the Nasdaq 100, how is its position actually affecting your overall portfolio in a positive or negative way? Unless you are able to say that there's no point buying it for some past return, that's just silly.